The IRS prohibited transaction rules are extremely serious, and it's very important that you understand how they work because the penalties and taxes involved are extremely high. The IRS does not mess around when it comes to auditing prohibited transactions. I've seen it personally. I've seen them blow up people's IRA accounts for $500. I have a client that wrote a check literally for $500 on a $500,000 IRA from his IRA to an entity he owns personally by mistake because the contractor he was paying had a very similar name to an entity he also owned, and he just screwed up. Honestly, he made a mistake, wrote the check. The $500, he didn't even realize he had it. This was a wealthy man, and the IRS audited him. He was over 70. I'm not sure why the audit was triggered, but he did get audited, and they simply said, okay, show me what you did with the money. And they sent him all the checks, and they saw an entity that he owned. The check was written to it. Agent basically said, listen, you did a prohibited transaction, you're done. And he said, well, it's only $500. My intent obviously wasn't to do it. Are you going to blow up my entire IRA? And we went back and forth, and the IRS agent spoke to her supervisor, and they basically said, yeah, you screwed up. Intent isn't part of this. It's almost like strict liability. You're done. And it's funny because the IRS actually hurt themselves from a tax standpoint by doing this. And I'll explain why. The way it works when you do an IRS prohibited transaction, if you get nailed, the IRS will go back to the January 1st of the day you do this prohibited transaction. So if you screwed up in January 2010, they only catch you in 16, let's say, or 14, let's say, they'll look at the value of the IRA in 2010, not 14, okay? Which in this client's interest was pretty significant. So we all know in 2018 the real estate market crashed. This guy picked up some really good properties in 2010, really low values. But he wrote that check in 2010. So now it's 2014, the values have been up like 50%. And the IRS says, okay, sir, you screwed up, we're going to blow up your whole IRA, and we're going to tax you, we're actually just going to tax you. He got out of any penalties. They technically could have gone, I've seen 10% to 100%, and they could nail a disqualified person, which is a IRA holder and any lineal descendant, generally have the right to have penalties up to 100%. So the way the IRS stated is they said, okay, we're just going to tax you. And when we tax you, we're going to use the value when you screwed up in January 1st, 2010. Client's like, actually, you just helped me out because the value in 2010 was probably 50% of what it is today. So he actually ended up okay because he paid tax. He was 72. He paid tax on the value in 2010, even though it was worth 50% more in 2014. And now he owns the property personally, so he can get capital gains on anything else down the road. He was lucky based off that timing. But for most other people, if you do a prohibited transaction, you violate 4975C, 1A, B, C, D, E, and F, you can get into some serious trouble. First of all, tax. If you're under 59.5, definitely 10%. And if it's egregious, total violation, like you literally bought a house and lived in it, or you just took the IRA and bought yourself a Porsche or went to Disney, they can really go after you. I'm not talking jail or anything, but I'm talking up to 100% penalties. If there's fraud involved, I don't know, maybe criminal. But again, I have never seen anything like that. But if you are pushing the envelope, be ready, because if you do get audited, they'll get you on tax. If you're under 59.5, 10% penalty. I've heard over 100, they can go up to 100%, under 59.5 or over, depending on what's involved. The IRS is serious about this stuff because they need to protect their distribution rules. If people are just able to give money to their parents or children and dwindle down their IRA so when they hit 70, they got nothing left and they don't have to pay require minimum distributions, the IRS won't be happy. They're going to lose out trillions of dollars in revenue, and they need that revenue, obviously, to do positive things for society. So they're counting on that revenue as part of their budget. So that's why the distribution rules are there, make sure that revenue is there. In the case of a Roth IRA, I agree with a lot of my clients. The prohibitive transaction rules have a lot less value, teeth, because I didn't get a tax deduction to begin with. It's all after-tax money. What do they care if I invest in my business or my kid's business? But the rules are the rules. Maybe if everything's Rothicized, if they get away with the traditional IRA and go to Roth, maybe they'll do away with the prohibitive transaction rules. Probably doubt it, but who knows? But as of now, we've got to deal with these rules. It's important, very, very important to understand the tax. Penalties go up to 100%, definitely tax, and they'll go back to January 1st when the transaction occurred. If you have a $400,000 IRA and you write a $1 check, you blow up your whole IRA. Not the $1, $400,000, blown up, okay? In a 401k, actually, if you do a privileged transaction, only that transaction is blown up, not the whole 401k. IRA is different. You write a $5 check to yourself by mistake, and you got $10 million in your IRA, $10 million is taxable. And penalties as well if you're under 59.5. If you're over 59.5, they can also nail you with penalties if they want. So it's kind of at their discretion. The IRS does the audit. Technically, it's a weird interplay because the Department of Labor is technically in charge of prohibited transaction, but the IRS is involved with the audit. So you got to deal with the IRS because they're the ones who can tell you how much you owe, and if you're screwed up. The Department of Labor may forward the case to the IRS, but the way I've seen it is usually the IRS comes in. The Department of Labor really is more with 401ks, even though they have jurisdiction over IRAs. If you have to get an opinion letter or a private letter ruling, a lot of times you go to the Department of Labor. But I've seen with the audits, I've seen the IRS take control. I don't know if it was referred to the IRS by the DOL, but all I see is the IRS. I don't really see the DOL in the background. So again, the IRS are humans. They are nice people. I've worked with a bunch of them in IRS audits. They're not out to get you, but if you screw up, they will get you. And if it's egregious, they will push you and they'll punish you. So be careful and watch out for the prohibitive transaction rules.